Hey everyone, welcome back to Corporate Decoder. Today we're diving into a document so thrilling, it'll make you forget your favorite TV drama. We're unraveling the secrets of John Hancock Premium Dividend Fund's Prospectus supplement. What does it all mean for you? Let's decode it together. This isn't the full prospectus, but a supplement, meaning it adds to the main document. Think of it as extra details on a specific deal. This one is all about offering up to 2 million more common shares. John Hancock Premium Dividend Fund is a fancy name for a company that invests your money in other companies, specifically aiming for high dividend payouts and a little bit of growth if you're lucky. The main goal here is high current income and modest capital growth. That is, they want to give you a good dividend check while hopeful also growing your initial investment. It is all about dividend paying preferred and common equity securities. The fund is using John Hancock Investment Management Distributors LLC, that's a mouthful, to sell these shares. And that distributor is using UBS Securities LLC to actually sell the shares. The key thing here is they can't sell the shares for less than what they're actually worth, the net asset value or NAV. The sales can be made on the New York Stock Exchange, that's where the action happens. The distributor gets 1% of the gross proceeds and they then share that cut with UBS. They have an investment strategy of putting at least 80% of its assets into dividend-paying securities. They will focus on common stocks of companies that have strong financials, are large, have good credit, and importantly, pay high dividends. John Hancock Investment Management LLC is the investment advisor and Manulife Investment Management US LLC is the sub-advisor. So Jay Haynes is in charge of Manulife. If you want to buy the current shares of the fund, they're listed on the New York Stock Exchange under the symbol PDT. If they sell new shares, they expect those to trade under the same symbol. As of March 26, 2025, the last reported sale price was $12.91. They might use leverage, meaning borrow money to invest more and juice up the returns. But this can be risky if investments don't perform. The shares have traded both above and below their actual net asset value, so you might pay more or less than what they're really worth. Let's scroll to some important stuff about risks. Investing in these shares is risky and you could lose all or some of your money. Let's look at the expenses. This table is designed to break down exactly where your money goes if you invest. For starters, it lists shareholder transaction expenses such as sales load and offering expenses. The sales load, one Batston, is the commission they charge you when you buy in. Then there's offering expenses, which are the costs of actually making these shares available to buy, estimated at 0.93%. The management fees are 1.29%. Interest payments on borrowed funds are 3.72%. This is the cost of using leverage, which can eat into returns. Other expenses are 0.25%. That all comes to a total annual expense of 5.26%. They also have a contractual expense reimbursement. This is where the advisor agrees to cut their fee a little if the total assets under management for these kind of funds get really big. After that reimbursement, the net expense is 5.25%. They've got an example: if you invest $1,000. After 1 year, your expenses are $71. After 10 years, you will have paid $528. Of course, this is just an example. The capitalization table shows how the fund is structured. They have about $674 million in net assets. There are around 49.2 million shares outstanding. The net asset value per share is $13.70. This net asset value is calculated by dividing the net assets by the number of shares. Then there's a pro forma as adjusted, showing what would happen if they sold the new 1,786 shares. That would bring in about another $23 million. Bringing the net asset to 690 such sale, 5 million. However, actual sales, if any of the common shares, may be greater or less than $12.91 per share, depending on the market price of the common shares at the time of any such sale. This section is on market prices and net asset value. These common shares have traded both at a premium and at a discount, so they've been more expensive and cheaper than their actual value at different times. Let's have a look at the table. You get the market price, high and low, the NAV per share, and the premium or discount. Looking at January 31, 2023, the high market price was $14.20. The low was 12.72. The high EV was 12.24, and the low was 12.84. What does that mean? At the highest point, the shares traded for 9.65% more than their actual value. At the lowest, they traded at 0.93%. What does that mean? At the highest point, the shares traded for 9.65% more than their actual value. At the lowest, they traded at 0.93%, or just a little less than that actual value. Now, let's jump to October 31, 2023. The high market price was $11.14. The low was 8.97. The high NAV was $11.94, and the low was 10.41. Here, the shares never traded for more than they were worth. They traded for as little as 13 out of 3 cents a lot than their value. The last data point, January 31, 2025, the high market price was 13.23. The low was $12.00. The high end was 14.20 and the low was 13.27. A descent at dollars reported figures from March 26, 2025. Put the sale price at $12.91 with an NAV of 13.70, a discount of 5.77%. The fund started in 1989, is registered under the 1940 Act and located in Boston. The outstanding securities table summarizes the key shares outstanding. The common shares no par value has an unlimited authorized amount, zero amount held by the fund, and 49,185,225 outstanding. Basically, they plan to invest the money they get from selling new shares within 3 months. Here's where the distribution of shares is described. They've got a deal with UBS who will try to sell the shares. UBS gets paid a percentage of the gross proceeds for this. The final sections talk about where you can find even more details about this fund, such as its statement of additional information. And last but not least, standard disclaimers that this is not a crystal ball and past performance means nothing. And now, giving my thoughts. John Hancock Premium Dividend Fund is trying to sell more shares and keep those dividends flowing. But investors need to watch out for those management fees and costs and that leverage, because those can eat into your returns. It seems to have a lot of moving parts that are not obvious at first sight. And those fluctuating premiums and discounts can make it a gamble. It also looks like it is trading mostly at a discount, which isn't the most exciting thing. Kevlar would want a bit more of an upside opportunity for the risk, but I will let you make that call. Thanks for watching. If you found this breakdown helpful, hit that like button, leave a comment, and subscribe for more Corporate Decoder.